signed by the President of Nigeria in June this year, which will be effective from January 1st, 2026. We have four different laws. We have four different laws that have been signed. We have the Nigerian Tax Administration. We have the Joint Tax, and we have the Nigerian Revenue Service Establishment Act. We have the Nigerian Tax Administration Act as well. Basically, we have the Nigerian Tax Act, which is what really concerns us. The Administration Act is literally just to talk about the admin. Then the Establishment Act for the Nigerian Revenue Service is just to talk about the changing of FIRS to NRS and what the tax authorities are expected to do. To start with, the Nigerian Tax Act, the overview is just to consolidate a whole lot of taxes. We know in Nigeria, let me put in this, we've had a whole lot of tax laws in Nigeria before now. And all these tax laws are scattered around managing of more than 60 different taxes. So what the Nigerian government is trying to do in this essence is just to consolidate all these scattered tax laws into one unified legislation. And this is what they have been able to do by having the Nigerian tax law. And what do these try to achieve? One is just to simplify. The tax regulation. So if you and I, even if we are not knowledgeable in taxes, we can pick up the Nigerian Tax Act 2025, read through it. Yes, there has some complications or some interpretation issues, but at least we know that, okay, all this is just in a 400 pages document, which we can as well refer to instead of having different taxes, tax laws scattered around. This is one of the reasons why we have the new Nigerian Tax Act 2025. Introduction of clearer guidelines, a whole lot of complications. We are trying to ensure that the law puts all this together and it is being clarified. Majorly, let's take, for instance, the real estate industry. Before now, there have always been complications where some people, the law was not clear about whether or not real estate transaction should be subject to value-added tax. So we've had a whole lot of issues where the tax authority, we write to real estate companies, we write to realtors and all that for transaction on landed properties and be asking for value-added tax because the law was not clear before. But the definition of goods is something that is movable. But we know that land is not movable and houses are not movable. But yet, they try to bamboozle people to paying value-added tax on such transactions. But with the advent of this law, it shows a clear guideline. It specifically says that land and landed properties are not subjected to VAT. So this is some of the clarification that the Nigerian Tax Act 2025 are actually come to explain to us. And the establishment of tax incentives, yes, we know, in as much as we are looking looking at the fact that this is still tax. No matter what we think about it, yes, it is tax. But trust me, in the course of this conversation, we'll get to have conversation around some incentives as well, which if you are not aware of, definitely you will not be able to utilize it. But if you are aware of it, you'll be able to utilize it to reduce your tax liabilities. So these are the conversations that we'll be having in the course of this discussion. So like I mentioned, we have four laws that was passed. So the Nigerian Tax Act, we have the Nigerian Tax Administration. This is just literally to explain what we have mentioned before. It's just establishment and standardization of the administration arms of the FIRS. So we have the Nigerian Revenue Service Establishment Act. This literally majorly discuss how the new tax authority will be able to manage and administer the tax. So the former Federal Inland Revenue Service that we used to know will now be known as the Nigerian Revenue Service majorly. So it's looking at also consolidating of various revenue generating agencies. Like we have the custom collecting money, we have FIRS collecting money, we have SON collecting money, we have NAFDA collecting money from people. So this act also is looking at consolidating all revenue generating authorities in Nigeria to one body, which will be referred to as the Nigerian Revenue Service, as against the Federal Inland Revenue Service that we used to have. And lastly, we have the Joint Revenue Board. So the Joint Revenue Board is just to act as, just to help to facilitate the collaboration between federal and state tax authorities. So the Joint Revenue Board, they have been there before, but now we are having the Joint Revenue Board Establishment Act, which is majorly to establish a framework for joint revenue collection, such a way that both any report that is submitted to federal government or to state government, they can both collaborate, look at it together and ensure that we are all giving the right report and work together to, at the end of the day, collect their taxes, and ensure that the taxes collected are accurate and are right. So that is just that. So let's just dive in after the introduction. Let's dive in basically into what the government intended for the purpose of this report, of this new tax laws. So one is that we have, like I mentioned earlier, we have several taxes before now, and we have different tax laws. For instance, for the administration of the company income tax that we all know, we have what we call Company Income Tax Act. For personal income tax, we have the Personal Income Tax Act. For value added tax, we have its act. Capital gain tax, we have its act. So now, even for stamp duty, we have Stamp Duties Act. So now this is to consolidate all these different tax laws, the petroleum profit tax and the likes, to put everything under one pillar and one document, And also, we have a whole lot of taxes in Nigeria. You will hear about radio taxes for local government, television taxes, a whole lot of taxes, that is actually even giving business owners headache. Because by the time you wake up today, you see letter from Mr. Hay, you see letter from this, you see letter from that, or everybody trying to, milk funds out of you. But now, the essence of this is to consolidate all laws so that you can pick up a document and have an understanding of your liability tax obligation to the states and the federal government, as the case may be. Another major thing that this tax will be looking at, which I think those of us on this platform might not be happy about, because I know as real estate investor or realtor, I believe that we are far from being average Nigerian or poor Nigerian. So definitely the essence of this tax is also progressive. This means that for personal income tax administration, this tax is to ensure that the low income earners, the people at the bottom of the food chain in Nigeria, pay close to nothing or even lower than what they used to pay before. So what this means is that I think anybody that is earning 800,000 or below is totally exempted. We are going to have details of that when we get to personal income tax. Totally exempted. And anybody that is earning below, just above 800 to as much as earning 3 million every month, you will literally be paying lower taxes than what you used to pay before. You'll be paying lower taxes than what you used to pay before. So, but anybody earning above that, which you and I, we agree that anybody who is earning well above that on monthly basis, maybe you are earning about 50 million naira per annum as an individual, then you are not poor. But we will not be happy about it. But going forward, anybody who is earning that much will now be paying more. So what this tax is just all about for personal income is that, okay, let the poor breathe, like our president used to say, reduce our tax liability for the poor people, meanwhile, literally increasing the tax liability to the people at the top of the chain. That is exactly what this tax is going to be on. I won't want to waste more time on this. The OECD is more about international multinational companies with their minimum effective rate tax. Then the major thing that I think we should also take home in the course of this conversation is that, see, there's no significant changes. To be sincere, from my own hand, there's not like significant, especially to those of us who own a company and the people who are individuals. There's no significant changes in the tax law that will affect us significantly. But the fact that it is now technologically driven, that is the major thing that I think would be an issue. So even a poor man, like, that is not paying much before, that is going to be paying less now. Most people are not even paying anything before. But at this point, we are all going to be paying, because the tax now will use technological means to ensure that all transactions are being tracked and traced to ensure that we all pay what is due to the government. We are going to get to that in the course of this. I won't want to waste most of our time. So let's go directly to the key updates. I believe we're all business owners, and if we are not, we are self-employed. So that means we have right to pay both maybe corporate tax or personal income tax. So let us just look what we used to have before and what we will have now going forward. The first thing, let's look at the CIT, company income tax for large company. I want to believe we understand what company income tax is. Literally, this means the tax that is being paid by companies at the end of every accounting year after deduction of all allowable expenses. Focus on allowable expenses. So we have all our revenue or sales for the year, or commission as the case may be, or as an investor, you have all your and you are investing as a company now, not as an individual. You have all your revenue comes into your company. Then you deduct all your allowable expenses. Before now, allowable expenses need to be wholly, reasonably, exclusively, and necessarily for that business. But now it has changed to only wholly and exclusively. So for any expenses that is not wholly, that means the whole of that expenses should be for the purpose of the business, and it should also be exclusively for the purpose of the business. So after deducting all these expenses, at the end of the accounting period, before now, companies are expected to pay 30%, but now it has been reduced to 25%. That means that the company now, instead of paying 30%, by the commencement of this law, it is expected that we will be paying 25%. Then for the small companies that are not really doing so much, so before now, if any company that is not doing up to 25 million in sales, they are excluded from paying any form of taxes. But note, this does not mean that we will not be filing for taxes. Filing for taxes means that we should be submitting the taxes, that's what we have sold and all that. Then we should prepare our account and submit to the tax authorities. So before now, if you have a turnover in a year that is less than 25 million or 25 million, you are not supposed to pay any tax. But now it has been increased to 50 million. But kindly note that even if your turnover is less than 50 million, but you have total fixed assets, you have a big car that's worth much, you have an office space, you have, you own property, fixed asset that is more than 250 million, then you will pay. But if your turnover is less or equal to 50 million and total fixed assets, people used to forget this. As a company, if your total fixed asset is less than 250 million, then you are still going to pay no tax going forward. So, and now there's an introduction of development levy. Before now, it used to be TET fund, that's education tax, petrol, police trust fund and the likes, which used to be 3% and 2.5%. Now it is now development levy and it is 4%. Company income tax, we have it there. It used to be max of 24, now it's max of 25. tax exemption, you know, and all that. I don't want to bore us. Let's go to where we are. Personal income tax. I'm going to focus this on realtors. So, or investors, if you are earning money, personal income tax is not only on money that you collect as commission or as salary or you earn from your personal business, which is an enterprise. No. Personal income is paid on all income, like the name implies, personal income. Any income that is personal to you. Maybe as an investor, you are collecting rent. As a realtor, you're collecting commission, you have side hustle, you have this, you are selling another thing by the side, you have a shop. All the income that you earn for that year will be subjected to this tax as listed on this table. So it starts by saying from 0 to 800, anybody in a year, please, it's an annual tax, is annual base. So if in the whole of the year your earnings is not up to 800,000 or it is 800,000 or less, you will not be liable to any tax liabilities, none at all. Then if it is from 800, the next 2.2 million, that's between 800 and 3 million. So what people don't understand about this is I've listened to a whole lot of people online that will just say, if you earn so amount, they will just charge 25 million. They will charge 25%. Our tax is now 25. No. So irrespective of what you are earning, you will follow this same table. Is a progressive tax. So that means if someone is earning, let's say your total income for the year is 50 million, you will be exempted for 800. Your first 800,000, it will not be taxed. Then after that, you will still enjoy a rent relief of 20% of your actual rent. So now let me take this to our investors. So if you have a property, what government is trying to do with this rent relief, before now we used to have consolidated relief. Now they have rent relief. So that means people will now start asking you for the rent receipts, because without getting the rent receipt, they will not be able to claim the rent relief. And the implication of this is that government will now be tracking people that have, you know, collecting rent. So if you have rent, you collect. I may suggest instead of issuing the rent in your name or the company name, you might have to get probably a lawyer or a third party to be handling such receipting, so you get your money, because this is another means of tracing and tracking you as an investor as well. So when you use your name to issue the receipt, that means when your tenants use it to claim relief, definitely they will trace and track it back to you. So these are one of the things that will happen in 2026 to investors. So it is just progressive. So they will your first 2,200, they will charge 15% on it. Your next 9 million, they charge 18% on it. If your money has finished, your annual salary has finished, that's the end. But if it still remains, they charge next 13 million, they charge 21%. Next 25 million, they charge 23. Then any amount that is above 50 million, they charge 25. So it's not like they will just go to your whole money and charge you 25. So they will first remove your relief, remove the 800, then they will remove the next 200 at 15, remove the next 9 million at 18, remove the next 13 million at 21. Then if your money is still remaining, they will keep removing it. And when they have exhausted all these rates, then the balance will now be charged at 25%. This is how this work. So how to calculate income table? Okay, we've just done that now. That's what we just did. So I think now we've been able to talk about the company part of it. I believe there will be a lot of questions. We can have that conversation when we get to question and answer. And the personal income tax as well, we've been able to treat that as well. If there's any question, we can as well note our questions down and we'll do same. So now let's go about well, before I move forward, I would like to mention that for the purpose of these taxes, is not that the essence of the taxes is not to create issues, it's just to create clarity. So, like I mentioned earlier, that yes, people that are earning more would literally pay more from personal income tax angle. But for companies, because you are going to have a whole lot of allowable expenses to reduce your exposure, and as an investor as well in real estate, there are a lot of privileges that are given to encourage real estate investment. So these are the things that we'll discuss in the course of this conversation as well. So please don't let us be scared that the more you earn, the more you pay and all that. These are just personal income taxes that we can actually deal with. So let's go to capital gain tax. This is more of like real estate transaction taxes, because when you sell a fixed asset, might not necessarily be land or your property, it can still be your car and the likes. So these are reliefs these are the taxes that we pay on the profit. Please, let's take note of that. It's not on the cost of the transaction. Maybe I bought a house for 100 million and I'm selling it for 110 million. This tax is only on the 10 million. And in fact, to make things better, for any capital gain tax, for any capital transaction, sales of capital fixed assets that is below 150 million or less, and the profit on it is 10 million or less, there is no tax at all. Unlike before now, that we have to pay whenever you are disposing an asset, you pay capital gain tax on the profit. But now you will not have to pay the capital gain tax on all transactions. If the transaction is less than 150 million, or the profit on that transaction is less than 10 million, then there will be no capital gain tax on it. And also, if you are selling as an individual, good. And also for capital gain tax, if you are selling your personal house where you are living as a house owner or property owner, if you are selling your primary residence, there is no capital gain tax at all. If you like, sell it for 1 billion, make profit of 1.5 billion on top, there's no tax on that. If what you are selling is your personal residence, it's only when it is commercial property that is when you have the capital gain tax. So as an individual also, if perhaps there's a reason for you to sell cars during the year, which is your car or is commercial, if you are selling maximum of 2 cars in a year, there's no capital gain tax on it. It's only when you are now selling more than, except you are in a car dealership business, I doubt why somebody will be selling more than two personal cars every year. But this is what the law has said, and these are just to give people, soft landing, as the case may be, so that the taxes will not be much. So what we are looking at now is just that before now it used to be 10% flat on capital gain tax, but now it has been moved to 30%. So if you sell your property, there are chances that you might have to remit a capital gain tax of 30%. So now we have property transactions, VAT and residential relief. So like I've mentioned earlier, that on residential, there's total exemption. There's total exemption if residential exemption, the sale or lease of residential property remains exempted from VAT. So there's no VAT that will be charged on that if you are selling a residential property. So if you are selling a residential property, no VAT is chargeable on that. It's only when you are dealing with rent or sales of offices that attract 10% VAT. And kindly note, I need to put this out, that the obligation to pay VAT is on the buyer or the beneficiary of the transaction. I think I need to mention this. I did not emphasize on VAT because real estate transactions hardly have much to do with VAT. So, but bottom line is that the onus to pay VAT lies with the buyer or the beneficiary of that particular transaction. So it's just like I'm buying a car now. If I'm the one buying, I have the obligation to pay the VAT on it. And I need to also mention that properties that are residential are totally exempted from VAT. I think I've already mentioned that in the course of the presentation. And also for let me just mention this. This is also a plus for developers. You know, real estate now is now zero rated. You know, so what we mean by zero rated, because people were like, okay, before now you say something is VAT exempted, which I mentioned at the beginning of the presentation, that okay, real estate transaction is VAT exempted, but now it has been moved to zero rated, and people will be like, well, we say something is exempted, you are putting it to zero. So what zero rated simply means is that even if you pay VAT in the course of, now let's say real estate, before now, when you are buying cement, you are buying sand, you are buying parts, materials, they have VAT on them. It's just that when you are selling, you will not put VAT when you are selling. But that's exemption. At your point, you are exempted. But what zero rated means in this case is that those VAT that you pay to people from cement, from buying materials, from buying iron and the likes, if you are able to gather all those invoices and you are able to file accordingly, zero rated means government will refund you all those VAT that you have already paid. They will credit your account. That's what the law says, that they will credit your account back. So that is the zero. You will not have to, pay anything.
2026 yìí máa lé o.
Clarity ni. It is just a function of us trying to understand what we are up to, and probably get a competent consultant, especially in tax, to help us navigate through it without contravening the law. What I think we should just do now is to ensure that we will get there. We'll get there. I will tell us exactly what we need to do to ensure that there's no issue. And also, lastly, I need to state there that sales of bare land, that is just land, no house on it, nothing, we should know that it's totally exempted from value-added tax. It's just a land. It's not like you have not bought any material to put land there. So if you are just selling and you don't have any VAT to claim, the land is on top of the ground. The person who sold it to you will not put VAT on it. And you too, you are not supposed to charge anybody VAT on it, which means the essence is to make land cheaper. Just imagine that you want to buy a land of 500 million and they will still add 5% on the land again. That's another 50 million. So the government here is trying to give us relief and make the real estate industry more lucrative for the investors to be in. So we'll be talking about the stamp duties. So stamp duty is on contracts. We know that it is on contracts. So for clarity, stamp duties are repealed. Yeah, we have the Stamp Duty Act before. So now it is now consolidated in the Nigerian Tax Act. So it's just, we have for lease, I think we should mention it for us, for leases that is between 0 to 7 years. This is directed at the investors. If you have a property and it's going on a lease between 0 and 7 years, we've mentioned that this is not transaction that is not vatable. But note, there is a stamp duty on it. So if the lease agreement is 0, that means even rent, because rent is also from 0 to 1 year or 2 years. So any lease or rent between 0 to 7 years, that contract will attract 0.78%. I'm putting it again to you, the onus to pay stamp duty as well lies on the beneficiary of the transaction. So if you are the landlord in this case, your tenant should be liable for that. So that means when you are invoicing or when you are sending the bill, when you agree on 5 million, then it's 5 million plus 0.78%, except if you have already agreed to to self-charge yourself the 0.78. That means you collect the 5 million and you remove the 0.78 and go and pay. But if not, the onus to pay is on the beneficiary of the service. So in this case, you are the one the landlord is providing and the tenant is enjoying the service. So if it is above 7 years, then it will be 3%. If the lease is above 7 years, it will be 3%. Then we have deed of assignment. So for deed of assignment, even if the land is free and you are dashing somebody the land, you should be able to value it and pay 1.5% on the contract, because definitely you are going to sign a contract to transfer the property to the next owner. So note again, the onus to pay for this 1.5% lies on the buyer. So lies on the buyer. I think, okay, I have it, a liability clarification. The Act explicitly states the transferee buyer is liable for transfer duty and the lease tenant is liable for lease duty and should be remitted or paid not later than 30 days after execution of the contract. This has been there before. This is just to clarify, and let us know what exactly we are doing. And the benefit of stamp duty, this is that for landed property, any property with less than 10 million naira value is totally exempted from stamp duty. So if you are buying land that is 5 million, 7 million, 8 million, to 10 million, it is totally exempted. We can all see that this law is actually has come to being in order to ease the affair of I'm telling you, these poor people in the country is more than 90%. In fact, based on what the chairman of the Presidential Committee on the Tax Reform said, he said this is about 97% of the people that have been taken off the tax net. Just the top 3% are the people that this tax really affect. So, anybody earning more than 2 million naira monthly is part of the 1% in the country. So in the real sense, if we say people earning more than 2 million is 1%, and we are talking about transaction of more than 10 million, this simply means that about 99% of the people have actually been exempted from liability of this stamp duty, and only the top 1% will have to face it. So this is also to ease the affair of the populace. I think the major fear people are having is just at the end of the day, it is not a function of because people are not paying at all before. So even if you are telling them that now you are paying less, but you will pay, it is still money out of people's pockets. So we understand how this feel at the end of the day. So rental market, rent relief, and rates. This literally for those of us in real estate. So for rent, in order to encourage, it is said, like I mentioned, that tenant rent relief, individual can deduct 20% of their annual rent, capped at 5 million. So this simply means that you can deduct 20% of your rent, but when 20% of your rent is more than 500, we choose 500. So it is either 20% or 500, the lower of the two. So if somebody's rent is 1 million, 20% is just 200. You submit your receipt, they give you relief of 200,000. But if somebody's rent is now 6 million, or let's say, yes, 6 million, and 20% of 6 million is about 1.2 million, definitely they will only give you to the maximum of 500. They will not give you the 1.2. So this is also to encourage the real estate industry, because you have to rent before you can have the rent relief. So when you have a property, I believe this will make people rent more. People will rent more, at least in order to reduce their tax liability. And I believe people might even be willing to say, okay, no problem. When you give the rates for rent, they know that, okay, they are getting a relief from the government in this respect. This is also to encourage the real estate industry and ensure that more funds is being earned by the real estate investors. Now we have the real estate investment trust. You know that the real estate investment trust is totally exempted from withholding tax. This simply means real estate investment trust is just like you have a company, you know, and you have a group of people that invest in that company for the purpose of building properties, you know, buying land, doing real estate business. So in as much as 90% of the total earnings of that year is being distributed as dividend to the people, then you don't pay any withholding tax. We all know that now for you to invest, when you are collecting your money back, there is about 10% withholding tax that is being charged on investment. But now they are saying for real estate, because we want real estate to grow, when you invest like that and you have a company that handles the pool of your resources and invest it in real estate, then you earn money, and about 90% of that revenue is being distributed to the people, to the investors immediately, then you will not be charged withholding tax. But before now, for companies, there are 10% withholding taxes and 5% withholding taxes on individual transactions. So this is also for the purpose of encouraging real estate investments. So also the withholding tax on construction, so maybe construction of road, houses, you know, any property, has been reduced to 2% as against 2.5% before now. So this is also to encourage and make sure there's enough money when you are building houses or you are investing in properties. So I just want to brief on the strategic implication for real estate sector. I divided into three, you know. So one, for developers, the 30% capital gain tax on corporate disposal means a whole lot. And it means that flip strategy are more expensive. That means flip strategy is more expensive, because when you buy a property and you hold, then you sell, you have to pay capital gain tax on it. So we are encouraging that developers should consider holding assets in rates, you know, as against holding assets as a developer and you want to resell. So you hold it in trust, you have people invest together so that you will not have to pay any capital gain tax, and the withholding tax has also been exempted. So this is a more, you know, viable business line for real estate developers to strategize in 2026 in order to reduce their tax exposure. For high net worth individuals, which I believe all the people on this call belongs to, it is also very important that high value property flip will now trigger a tax of 25% as an individual. So what we mean by that is that if you want to sell your property, if you are doing it as a company, you pay the company income tax. And also if you are doing it as an individual, you pay personal income tax, or you pay the capital gain tax of even 30%. So we are also saying that the best thing to do in a proper document, the best thing to do is probably to invest in the rates as well. You need to do that. Join an investment trustee, put your fund in it, share margin at the end of the year, and you'll be able to avoid a whole lot of taxes that has to do with this. But what I'm going to say again is that we should keep, as a company, we should keep proper documentation of acquisition and all costs that are attributable to that. Like I mentioned, that at the end of the day, you are only going to pay capital gain tax on profits, not on the cost itself. You're only paying on profits. So we should bear that in mind. So we should keep all our records straight. We should ensure we have proper documentations and ensure that all allowable expenses are supporting documents. So at the end of the period, if we need to say, okay, I bought this at this rate, I did all this upgrade or renovation or whatever to it, this is what I did, then this is what I sold it. At least it will be clear that you have incurred, you bought at 100, but you incurred additional 50 and you sold at 160. So which, I mean, this my example is even totally exempted from capital gain tax, because the total cost is now 150 and the profit is just 10. But if it is more than that, let us keep our records and ensure that we are able to substantiate this. So for commercial landlords, with VAT implication, lease agreement should include, yes, for investors that are landlords, this is very important. State it. in your contract that the VAT is not included, like the amount you are charging for your rent, there's an obligation to pay VAT on it. It is very important that you state it in your contract so that when it is time, your tenant will not say what I'm supposed to pay is just 5 million. It is not 5 million plus VAT, and all that. So these are depending on the amount or the fee, the rent you are charging the tenant. Okay, pardon for individual. For individual, capital gain dance will be taxed at their applicable personal income rate. Yeah. So for individual, that's why what I have on the previous page says 25%. Because as an individual, whatever money that you make at the end of the period, you are going to pay your personal income tax on it. So at the end of the day, it is just going to be that same progressive table that we have that you pay on it. So for the purpose of this, I'm going to share a link with the organizers of this that will link us to the page where we can download, or I can even send copies of the 4 laws to them so they can share with all members of the that are in this conversation or meet discussion. So now, so before we go here, so literally, as far as we understand that taxes 2026 is going to be a new terrain for us, and what is major on this is that besides the fact that we'll be paying taxes, we have a whole lot to do with that, there is going to be a whole lot of technology-driven ways of collecting taxes. And we know that for every transaction that passes through our bank, it will always leave a digital trail. So it is very important that we keep all our records straight. Any money that we are sending out, let us properly describe it. If it is a gift, let us mention it is exempted. If it is any money that we are expending on any transaction as a company, let it be explicitly stated. Okay, this is for buying of water. This is for, we need to explicitly state it on our bank statement and engage an accountant to help us prepare a proper financial document. Because another thing that will be happening next year is that there's what we call e-invoicing, but unfortunately we don't have the luxury, the time to discuss this extensively. But I'll just brief what this e-invoicing means. What it means is that from November this year, for every invoice that any company raises, you will have to go through from your portal to FIRS portal before it gets to your end client. What this means is that once you generate an invoice, it has to be transmitted through FIRS portal. It has to be transmitted through FIRS portal. So you cannot say that my total sales is 1 million, meanwhile it is 500 million. No, because for every transaction, it moves through FIRS portal. And if you do not follow this, it's going to be another tax evasion penalty, which we don't want to find ourselves in this. So it is extremely important that we ensure that we disclose all our records, probably get a consultant that can help us manage our transactions and ensure that we pay the least tax possible within the confines of the law. So this is what we'll be having as discussion today. I try as much as possible to meet up with the time given to me. It's 7 o'clock already. I want to listen or get any question from the participants, and if there's any reason for us to have another discussion like this to further explain the tax law, including the withholding tax implications, then I believe Urban Living will reach out to do that. Over to you, Madam Moderator. Thank you and God bless.
Thank you very much, sir. I don't know if we all jotted because my notes is also full. Thank you for that session. So before we take our questions and answers, You can drop your question and answers in the chat box. And if you want to speak, you can raise your hand. So I will unmute you and you can ask your question. You can ask your questions. So I want to quickly just tell us about our ongoing member promo at Urban Living Development. So we have 3 projects currently, 20% slashed. We have Mega One Lagos, which is selling for 28 million currently, as opposed to the 35 million naira. Mega One Lagos is at Ibejleki, and it is a sea of all titled property. So this is an opportunity to own for less, a whopping 7 million naira discount. And we have Declan Gardens at Ekpe and Ogun State border. Declan Gardens is 3.5 million naira per 500 square meter plots. But due to this Ember promo, it's selling for 2.8 million naira. So this is a property that you can speak to your clients about. And we have Ibalode at Ibadan. It's also a government allocated sale home property. And it's selling for 4.5 million naira on this Ember promo, as opposed to 6 million naira per plot. So we can see that these offers are really, really good. So don't let us hesitate to share it with our clients, and we can also key into it. So I can see some hands are raised for questions, but I want to also ask Mr. Labanji. So concerning these new tax laws, what are mistakes that we as individuals should avoid in 2026?
Thank you very much, moderator. So, like I mentioned, the first mistake you should avoid is to think that the authority will not get to you. Try as much as possible to have it in your mind that they will get to you. And why I put that out first is that when you believe that these guys will not get to you, you will not prepare yourself ahead of time. But when you know that, okay, chances they may get to you, then you put your head down and ensure you do the right thing. The next thing I would like to say is that there can never be over documentation. Ensure you have more than enough documentation. File all necessary invoices, receipts, document. See, tax is as good as the documents available. There's no magic in taxation. It is just a function of how properly you are able to document all your transactions. And this will give you a whole lot headline when these guys comes around. So please don't assume they won't get to you. And let me put this out too. We are saying 2026. If tax authorities come to you in 2020, in fact, they will not come in 2026 because it's effective in 2026. So they will audit you for 2026 in 2027. So when they come for you, if you have not been paying for like 5 years back, 4 years back, they can audit all the trail. So it's not like this law started in 2026 and I will only be liable just for 2026. If they come for you and you have not prepared yourself, they may go as far back as 2024, 2023, 2022, as the case may be. So it's very important that we ensure that we do our proper documentation and believe that they may come for us and just do the right thing. Thank you.
Thank you, sister. So we have some questions in the chat box. So as a realtor, how do I remit my tax? What's the percentage charges, please? And does this mean that the 5% BRJ usually remove will no longer apply? That's the second question. When and how is the tax deducted? Is this instant deduction or I'm expected to pay myself?
Okay, thank you very much. Please, I'm going to answer, but if I did not, fully answer it, just let me know if I did not answer any of the question raised. So the first thing I believe she asked or he asked is that how do I pay withholding? How do I pay my taxes as a realtor? So as a realtor, you might, I don't know how you relate to your clients, Is it as a company or as an individual? If you are relating to your client as a company, you will pay company income tax. Then if that company is paying you salary, you are going to pay personal income tax from that salary. But if you are relating directly to your clients, in this case, it might be BRG, it might be your direct clients, depending on how you render your service. So if you are relating as an individual, definitely your liability will be, your tax liability will be calculated as an individual, which will be using the personal income tax. So the personal income tax, like I mentioned, if your total revenue for the year is less than 800 as a realtor, 800,000, you will not pay any tax. If it is more than 800, you won't pay on 800. Then the next 2.2 million, you pay 15%. The next one, you pay just like we have on the tax table. Then if it is well above 50 million, when you get to 50 million, you pay 25%. So that's just the way you will pay as an individual realtor. But Ololade is a realtor, but I'm relating to BRG as both finance. Now, both finance we earn money, and both finance we take out deductions, all liabilities, you take it out, all allowable expenses, you take it out from the commission you receive, then you pay 25% on the profit. Then in the course of removing all your allowable expenses, if you are also being paid salary, that your salary is an allowable expenses from your company, then as an individual being paid salary, your tax will be calculated using the personal income tax table. Then you pay on that as well. So these are the two ways. So I think he mentioned that if withholding tax is being deducted, how does this benefit? So withholding tax is still, sacrosanct. You still have to pay the withholding. It will be deducted from your commission. But we should take note that withholding tax is not a tax in itself. It is actually either company income tax advance or personal income tax advance. So that is the way it works. So when withholding tax is being deducted from you, it is expected that if you are relating to the company as an individual, they remit it to your payer ID with the state internal revenue. If you are relating with the company as a company, it is registered with your TIN with the Federal Inland Revenue Service, which will change to Nigerian Revenue Service from next year. So when it is being remitted like that, at the end of the period, when your taxes is being calculated, and they said, okay, let's say for instance, BRG has remitted 100,000 on your behalf, and your total tax that you are supposed to pay based on calculation as a company or as an individual is now 120. You will know that you already have 100, you will just balance 20. And if your liability is 80, you will know that you have paid 80, you still have credit of 20. So that's just the way it is. Withholding tax is not a tax on its own, it's just an advance on your personal income or company income tax, as the case may be. So do I still have any other question that I did not answer from that particular question?
No, sir, you answered them. So I want us to take questions from those that raised their hands. We still have one more question on the chat box, but all questions related to BRG. Our upcoming session will handle that. Okay. So let me read this question. So someone said, my question is, as a landlord that pays land use every year to Lagos state government, is the landlord still going to pay tax on rents collected from tenants?
Okay. Land use charge is a fee, right? It's not a tax in itself. There's a difference between taxes and fees. So when you pay land use charge on that rent, you've paid the state's rent. Now, when you now want to pay the personal income tax, you can now deduct that expenses, that land use. Say, okay, you receive 5 million. When you want to disclose your rent, because you are going to disclose your rent, like I mentioned earlier, personal income tax is the tax on all your income, all your income. So if you are an individual and you are you are doing like 10 different businesses, you must consolidate everything and report to government. So if rent is part of them and you pay land use charge on it, if the rent is 5 million and the land use charge is 200,000, remove the 200,000 from the 5 million. That means, and you must substantiate with the supporting document, which is the receipt or the evidence of payment of the land use charge. Then the 4.8 will be what will be taxed. They will not tax the 5 million again because you have already expended 200,000 out of it. So please, you will still pay tax even after paying the land use charge.
Thank you, sir. So the next question, please, what type of company registration do you advise realtors to do? Business name or company limited registration?
Sorry, again, please, kindly recap.
Okay. Please, what type of company registration do you advise realtors to do? Business name or company limited registration?
Okay, I'll try as much as possible not to advise, but I'm going to mention the pro and con of the two. So if you are using a business name, you are still seen as an individual. Like the enterprise and yourself, you are seen as an individual. So the only advantage you have there for registering an enterprise is that you'll be able to deduct your allowable expenses. If you are just an individual, all your revenue, all your income is taxed straight. You are not allowed to deduct any allowable expenses from there. But as a company enterprise, you'll be allowed to make deductions. And if you open an enterprise and your sales or your commission in this case is not up to 50 million, you will not be charged any tax. So, but as a limited liability company, you enjoy the same thing. It's just that you will pay after deducting all deductible allowable expenses. You will pay company income tax of 25%. You will pay company income tax of 25%. But if you are using an enterprise, after deduction of the allowable expenses, you will pay tax using the scale, the personal income tax scale. That means you have exemption of 800, then you go from 2.2 based on your profits, that's on gain, and then you go like that until you get to 25, 50 million, then you pay the 25% on any excess. So these are the two pro and con. So both have its own benefits and disadvantages. So, but for an enterprise, it will be seen as it's still personal income. So the profit you make will be consolidated, added to every other profit, and you will pay it as your personal income tax. As a company, is a distinct entity, is another person different from you. You pay your own income to the state revenue board, and you pay the company income at 25% after deducting allowable expenses to the federal government. So these are the implications. So it depends on the volume of transactions you are doing, which determine the volume of expenses you have. So as a realtor, if you are an individual, you are not doing so much, and all that, you can just do a limited liability company. So you might not even go as high as 50 million in commission. If you don't go up to that level, so that you'll be totally exempted, you'll be totally exempted. But for enterprise, is an individual, you are not exempted for the 50 million. Any profit that is remaining, even if your total sales is 10 million and you remove all your expenses, whatever that is remaining will give you allowance of the 800, and then you start paying taxes. So that's the way it works. I don't know if this will help give informed decision. I just don't want to be emphatic. I just want to point out the obvious.
Thank you, sir. So those on the live chat, Ahmed Akeme, you can ask your question.
Okay, good evening, sir. And are you hearing me, sir?
Loud and clear, sir. Thank you.
Okay, all right. Good evening. Thank you for this clarity. I really appreciate. So I just want to quickly ask, the personal income tax on salaries, is it on basic salaries, or because some companies sometimes they divide the salary, the basic salary, and then some allowances, and so of course most of the times it's allowances that used to add up to make that particular amount. So is it both that they will be taxing, or the basic salary alone? So that is one. Another thing is it 800,000 naira per month or at the end of the year? Because the articles I've been reading online says 800,000 naira per year. So if it is per year, if it is per month, is it pay as you go? Are they debiting that tax every month, or you have to file for whatever you have received for that year at the end of the year? That is my question. Thank you, sir.
Thank you very much, sir. So I'll start from the salary, basic, and allowances. Like I mentioned, personal income tax is on all your income. So it's not even about salary. So they will take all your salary. Then even if you have side hustle, you will report all the side hustle. If you have house that you are collecting rent, you will report the rent. So it's not even only what you are collecting from the company. It includes, if you are a staff and you are also a realtor, you are selling land for the company you are working with, the commission you are collecting too, you add it to the report, then you will pay on all your income. So it is personal income tax after deduction of your relief and allowances. Then you pay on all your income, be it basic, be it allowances, whatever, you pay on everything. That is about salary. Then you said, is the 800K annually or monthly? Okay, taxes are function of annual. So even if you are paying on monthly basis, it must have been calculated annually, then divided by 12. So as a salary earner, because government cannot, there's no way they will wait to the end of the year, then you will now pay once. So that is why salary, the pay as you earn on salary are actually calculated annually, then divided by 12 to get the monthly deductions that will be remitted to the government. So the 800K is actually annual relief if you are earning 800K, and it is not really 800K. In the real sense, even if you are earning about, I think, even 1.2 million, beside 800, before it gets to 800, you must have been given the rent allowance. So if you add your rent allowance to it, to be giving you about 1.2 thereabout. So in the real sense, if you are collecting average of like 100K, at the end of the year, by the time they remove your rent allowance, it will now fall to 800, and the 800 is tax exempted. So in the real sense, it is the annual income that we are talking about with that. So on when to pay. So if you are a salary earner, we believe you should be paying on salary monthly. Then at the end of the year, what people don't, okay, I need to put this out. At the end of every year, on or before 31st of January every year, all employers are supposed to file for all their staff that they paid and remitted for the previous year. So after your employer has filed for you, you as a salary earner who have side hustles is now expected to go and add, you have already paid on your salary. But if you have side hustle is not monthly. It might be once in 3 months, depending on when people pay. So you are supposed to now go and you go to your own portal. Everybody, when you have a tax ID, you have your tax portal. You now go to your own tax portal to file all your own other income that you made during the previous year. Then you pay the additional tax liability on it, and you are done. You can now get your tax clearance. So, but if your only income is salary, after they have paid all the salary for you, the next year your employer files, then after that, you just go and file as well. You go and file, and you tell them that it's only salary that you are earning, no other money. In as much as they cannot trace any money into your account. So I think you'll be fine after that. Then for every director or business owners, you are not supposed to be paying on monthly basis. You are supposed to file and pay on or before 31st of March of the subsequent month. So for transaction, for all the money as a director that you make from first, right, that you make from January 1st 2025 to December 31st, 2025, or not before March 31st, 2026. You are supposed to have reported yourself. In Nigeria, it's good. It's self-assessment. So you'll be the one to tell government that, okay, for all this year, last year, all the money that comes to me is 30 million. Then using the tax calculation table, the liability that I'm supposed to pay after removing all necessary allowances is 2 million. Take the 2 million, then you are good. Until they come and ask you, okay, where are the evidences? Where's your bank statement and all that to substantiate that what you calculated and pay is actually accurate. Let me put this out as well, that there are some exemptions, that there are some things that you can do to reduce your tax liability as an individual. So besides the fact that you are giving those allowances that I mentioned earlier, if you have life assurance, any money that you pay for your own and your spouse's life assurance is deductible from your income. So if you have 30 million or 50 million and you pay life assurance of 2 million, that will be taken out before they start taxing you, just like they will take the 800 out. So that's allowable. If you are paying pension, if you are contributing pension to any pension fund administrator, any amount you are contributing as pension will also be taken out before they start taxing you. If you are contributing any fund to the NHIS, any money you are paying to NHIS will also be taken out from it. Any insurance, HMO that you are doing, all those monies can be taken out from your income before they will now tax it. So these are some of the strategies that you can use as an individual to reduce your tax liability. Thank you.
Thank you, sir. Opaleye Lukman, please ask your question.
Okay, yes, I'm on mute now. Good evening, everyone. So, let me just get this straight. So, in construction, I want to ask which of the taxes is really applicable to for us during bidding, in us submitting tenders? Because what we've been doing all along is we had VAT rather, in our page after doing all the calculations that we need to submit. So the usual 7.5. But something happened today, coincidentally. Well, before I saw this, we went for a bidding process for a job meant to commence next year, maybe mid. So we in the room was the company's accountant. He was now making a case. The lady was now making a case that construction activities are no longer taxed. I was a bit taken aback because this is something that I've been flying around for like some years back that the government had to come on the defensive that they are still taxing. So when I now heard that today, I now said, oh, when I now saw this, I said, oh, this would be a good avenue for me to hack this before I begin to really make my research again. So I want to ask two questions to one now. Which of the is it VAT that will still be applicable from 2026 that we need to be inputting in our tendering processes? And again, is it still that construction activities are no longer taxable? Is it still valid? That's two questions into one. Then again, the other question is there are some inflows we receive in our company that are from diaspora that are dollar based. So we now had to convert at the local market, the Bureau de Exchange. So of course, the naira denomination has to be paid into the company account. I want to know what will be the implication of those kind of inflow from next year. I want to know. So the inflow in dollar into the account, then after converting, those one they come in maybe from Malam's name. So I want to know implication of that into the company inflow. Thank you.
Thank you very much, Mr. Kwale. On real estate, houses, when it is completed, or land is exempted from VAT. The services that is being rendered in the course of getting the land built, the houses built or whatever are not exempted. So the same way contractors or construction contractors are to land house builders, is the same way realtors are to the developers to sell their properties. So that service too is VAT chargeable. Your service as a contractor too, you have to invoice and charge your value-added tax at 7.5%. And the company have the right to also withhold your 2% and remit it to your tax identification for your capital company income tax settlement at the end of the year as well. So VAT is sacrosanct. As a contractor, you are liable to charge VAT. Now, let's go back to what I mentioned earlier. The developers now have the right, or the person you are rendering that service to, if it is construction of building, real estate, they now have the right, because that service, the real estate company is now zero-based tax. So they now have the right to write back to FIRS and reclaim all the VAT. That was why I was mentioning that when they buy cement, they pay VAT. They will reclaim the VAT on cement. When they build house, like from your service now, they pay VAT to you. They will reclaim it. So that means when you collect, you must remit, because when they write to FIRS to reclaim, FIRS will not just give them money. It's an avenue for FIRS to also ensure that they catch everybody who is doing contract or doing work or supplying the real estate companies. So when any real estate company pay VAT and they now write to FIRS that, okay, the VAT that I paid to so company, please refund to me. They will not just refund like an idiot. They will go back to their database, check the name of the company. Is this company tax compliance? The money that these people claim this month that we should give them, did this company actually remit it to us? Then, if it is the same way, they will now give it back to them. But please keep charging your VAT and ensure you remit, because when it gets to them and they have the time to claim, most companies will not even claim because they are not aware. So, but if they are aware and they do run their claim as a zero base, then they will come back to you to verify whether you are compliant or not. So please, it is still very, very important that you charge your VAT. And when you talk about other taxes, these are just the two taxes. You charge them VAT, they charge you withholding tax. These are the only taxes that are liable to your company, except at the end of the year, when you prepare your financials, you now pay the company income tax and the development levy of 4% at the end of the year. That's just it. Thank you, sir.
Thank you very much, sir. Before we take the last
Sorry,
call,
there's a second aspect of that question, the FX inflow, the dollar, the Iraq. So I already missed it.
Sorry.
That recap, yeah.
Oh, sorry. So I think what you mentioned was that if someone is paying into your account in USD, right?
Yes.
And you in as much as you have provided your invoice to them, your reporting currency is Naira. So no matter, even if they pay you USD, you definitely convert to Naira and you remit the equivalent in Naira. So if you have already sent in your invoice in Naira and they are paying in USD, is that the position? Or you send out your invoice in USD, they are paying in USD? Sorry, please. Can you clarify that?
No. We send invoices in Naira. So the money is paid in USD. So we have to now convert at the local market. And those payment will be coming from bureau de changes and all that. So what will be the implication of that? Is there any?
No implication. This is just why proper documentation is key. So irrespective of where the money is coming from, you should just be able to substantiate that, okay, this particular money is for this purpose, and you have your evidence. You must have issued an invoice, and when the person is paying, even if it is through bureau de change or anywhere, when it comes in, or maybe you have a dollar account, it comes into your account, then you transfer it to a bureau de change. It is not a transaction. You have the description there that this is just an exchange. It's just like fund movement within the system. So when it goes out, then it comes back in. Then when you spend it, that is when it's expended. So it's very okay. The VAT, value added tax on that transaction, is what you need to remit, irrespective.
Okay, yes. Thank you. Thank you.
Okay, am I free to proceed?
Yes, Idris Ndagba, I can ask a question.
Okay, thank you so much. I have three questions. The first one build on the recent answer regarding the USD transaction. The first one is I earn income from YouTube or Amazon precisely in USD, and then I pay tax to the US government before the income comes to my USD account in Nigeria. So do I also need to pay tax on it, or should I remit the money to my real estate business account, or I should keep it to my personal account as it used to be? That's the first question. The second question is uh my real estate agency is registered as a real estate company and having some employees. So whenever a company is paying me, would I need to pay tax immediately or until the end of the year that will file my tax? And the last question is for investors. How does it mean that investors have to pay tax when buying a property or until they generate an income from a property? Those are my questions. Can you hear me?
Uh, Thank you very much. Yeah, I can hear you. Please, moderator, I think you note some of these. I'll try as much as possible to answer the one I could pick. So if there's anyone pending, please, I'll appreciate if I can be reminded. So you said you earn income in USD from YouTube. I believe YouTube is domiciled in the United States, right? Sorry, Mr. Idris.
Yes,
YouTube
yes, yes.
is okay, good. So I'm not so sure because before now we don't have tax treaty with the United States. I think there's issue around our landmark description and all that. So we don't have, but we don't know by next year if we do have treaty. So what it means is that when you have tax treaty with another country, it means you have an understanding to exchange tax information. And whenever an income has already been taxed in country A, country B will acknowledge it as being taxed in country B as well. So for the purpose of calculating the tax liability, the tax that you've already paid in country A will be considered and vice versa. So that's the countries that we already have tax treaties with. And to the best of my knowledge, as at the last time I checked, we don't have with United States. But if we do have now, you have received income in Nigeria. Let me mention this again. Personal income tax is a function of residency. It is a function of where you live. So if you are in Nigeria, for instance, for over 183 days, that means we consider that you are living in Nigeria. You are not in another country. That's if you move around straight. Then in Nigeria as well, you pay your personal income tax to your state of residence, not your state where you are working. So if people live in Ogun State and work in Lagos, their taxes should be paid to Ogun State. If you have lived in Lagos for more than 183 days in a year, that means your taxes, irrespective of wherever you travel to, you should pay to Lagos State. So let me come back to your YouTube question. Now you live in Nigeria. You have the obligation to pay in Nigeria. But taxes have been deducted from your US employer. So now the question is, that tax that is deducted, is it personal income tax or withholding tax? So these are questions, because as a consultant, if you are not under their employment, I doubt if they will deduct withholding personal income tax from you. Most likely consultancy will just take withholding taxes. So now if they have deducted it, if we have treaty with the United States, when you are reporting your income, personal income, because this is not your company, this is you rendering service to YouTube, your personal income, you will disclose that amount. If we have treaty with the United States, you will deduct the tax that you already paid in United States from that money, because it's a tax that you've already paid. You cannot be charged on tax that you have paid again. You will deduct it, then you pay the tax on the rest. But Unfortunately, if we don't have tax treaty with the United States, you will report the income and it will be taxed accordingly. So that's the way the YouTube transactions will go. And to be sincere with you, this current tax fiscalization, which means use of digital trail to monitor all money, I think majorly is targeting even the people in the digital space, because a whole lot of money is there when we talk about crypto, when we talk about all these YouTube, TikTok, people making money and making noise about how rich they are. So if you are in that domain, I'm quite sure that they may want to come. So what we can do is to do proper documentation, ensure you keep your record straight so that there won't be any issue at the end of the day. So that is that for YouTube transaction. Then you mentioned something about whether you should keep the money in your personal account or move it to your real estate company. So it's simple. If you move it, you are rendering that service as a company in the YouTube, maybe you register it as Ololade Limited or Idris Limited, that's what you are using to receive the money, the inflow comes. Because the problem will now be that if they trace money to your personal account, then you pay tax on it, then they trace it to your own company account again. Well, there will be description to defend that. But if you want it to be taxed in the company, you have to relate to the YouTube as a company. They move the funds to your company account. It will now give you an avenue, at least, even if maybe, for instance, the real estate company, quote and unquote, is not too doing financially well. Once you report the YouTube money in that same financial report, all expenses that is overweighing even the real estate will be taken out from wherever income you also make as a company. Then the balance is what you will pay tax on, if there's any balance to pay tax on. So, but as an individual, you don't have rights to make any deduction besides the 800 and your 20% rent, or 500, which one is higher, which one is lower, sorry. That is what you will charge. And every other thing will be taxed. But when it goes to the company, you have the opportunity to deduct all allowable expenses, which are wholly and exclusively for the purpose of earning that money or for the purpose of the business. So that is that on the whether or not you should put it in your company or private account. So you mentioned as a real estate, I don't know, you mentioned real estate taxes or whatever. I don't know if that was what you mentioned. Sorry if you can recap. But what I wrote here is that you have stamp duty on it. I think you were asking about taxes on real estate transaction. Hello, Mr. Idris, are you there?
Okay. Yeah. So, as a realtor, you only get paid when you make a sales. You only get paid a commission. So, as a realtor, now I have my company register, rendering service as a realtor, group of realtors with other sales within my company. So, does it mean that the company will deduct my commission as a tax when paying me when I make sales, or they will pay directly to my company account, and at the end of the year I will file my tax?
Okay. So now, as a realtor, if you are relating, it depends on with what you are relating or whom you are relating with, the so-called company that you are relating with. If you are relating with them as a company, they are going to charge your withholding tax and remit it. Then at the end of the year, when you file your returns, you will know whether you have to pay more or you have to have a credit with the tax authorities. And if it is individual too, if you are relating to the company as an individual, they have the right to withhold your tax. But this withholding of tax will be per transaction. When tax is a function of income, gain, or profit. Income, gain, or profit. So if there's no transaction, there's no way there's nothing to charge. So immediately you have any transaction, probably you collect, somebody want to pay you commission, immediately the person will withhold the tax on it and remit to the government. Immediately, you have your tax portal, you will see it there. Once the person remits it, you will see it there. And at the end of the year, when you are now preparing your account as a company, or at the end of the year, when you are now filing as an individual with the state internal revenue, you will know your total tax liability, and you can now set off if what has been deducted from you is higher.